much exhausting. Yeah, VAT. Okay, so look at VAT. Yeah, VAT. And the question reads, the question for VAT. So Kenley Limited is a merchandising company operating in Kenya. The following transactions are extracted from the company records during the month of September 2023. They have been given that particular information: sales at standard, export to Egypt, purchases at standard rate, purchase of oil and fuel for delivery, repair of office furniture, audit fee, salaries and wages, purchase of stationery, electricity bills for the month and they were not paid, the legal fee, the purchases from traders not registered for VAT, then zero-rated sales. Additional, the VAT accountant established that the standard rate purchases were understated by 20%. Sales at standard rate include goods valued at 278,400 sold to a credit customer who was declared bankrupt during the month. Then a customer returned goods sold at standard rate valued at 58,000 to the company, and a credit note was issued immediately. Credit suppliers issued a debit note. So this one should be debit note in respect to supplies at standard rate amounting to 580,000. The accountant also established that an invoice of 480 from a foreign supplier was not recorded in the books. The import duty for these goods was at the rate of 20%. Repair of office furniture was carried out by a local carpenter not registered for VAT. So transactions are inclusive of VAT at the rate of 16% where applicable. So you are required to compute the VAT payable by or refundable to Kenley Limited for the month of September. VAT payable or refundable. You can just use it, create a VAT account. This end VAT account. So this is Kenley Limited. So Kenley Limited. Yeah, Kenley Limited. So VAT account. VAT account. So for the month of September, the month of September 2023, month of September 2023, and we shall have left border. So this is our input tax, and we have our output tax. Output. Remember, input we said is for purchases and payment of business expenses, and output is for sales. Output is for sales, and we start with output and the rest. We are told sales at standard rate was this, and I think there was a statement: sales at standard rate include goods valued at 278 sold to a credit customer who was declared bankrupt. Okay, so there's no problem with that. For that one, we shall have what we call the bad debt relief, and we are selling at transactions are inclusive of VAT at the rate of 16%. So inclusive, remember when they talk about inclusive is 16 over 116. Yeah, 16 over 116. When they say it is inclusive of VAT, so that is 16 over 116. 16 over 116. So which we shall calculate here. Let's say that this one will be multiplied by this value. Yeah, so this one we shall put it equals to 16 over 116. Yeah, that way. So that one now is okay. Yeah, 16 over 116. And the other one, so we have exports. Remember we said exports are zero rated. Exports are zero rated for VAT purpose. So we shall multiply this by 0, which will give you a dash. They are zero rated. Then this side we have the purchases. We have the purchases at standard. Purchases at standard rate. So purchase by the rate. Yeah, that way. Again, this one, yeah, that way. Then we have the purchase of oil and fuel. Again, this one is deductible.
Mwalimu,
Yes.
there was an adjustment to be done for purchase at standard rate
Yeah.
under note 1.
Yeah, under note 1. Yeah, so the VAT accountant established that the standard rate purchases were undercosted by 20, understated by 20%. Yeah, so this one they were understated, meaning that we shall take what we had as our purchase of 4 million. First, we multiply by 120 because it was undercosted by 120% to reinstate the part that was okay, so it was undercasted. Let me just restart the whole amount. This one will be wrong. Okay, it will be wrong because if it was undercasted, it means that this one will be 4 million. We multiply by 100. It was an undercast over 80. 100 over 80. Yeah, because it was understated by 20, meaning this 4 million is 80%. Yeah, it is 80%. What about 100? So we shall take 100 over 80, so that now we multiply by our VAT. Multiply by our VAT, yeah, to have 689,655. So it was undercasted. Yeah, we are not including the 120 is whereby you're including like the custom duty or the import duty. You multiply by 120. This one was under, so it was already 80. So you put the 20 to have the 100, but it is 100 over 80, so that to know the actual value before the understatement, it was how much. Then we are having the purchase of oil, yeah, oil and fuel for delivery, yeah, for delivery one, and for delivery is because it is used for delivery of the items. But we normally say if it is not used for delivery, then it is non-deductible. Yeah, not for delivery because there is no way we shall be able to charge that to the customer. It becomes non-deductible. Like the repair, yeah, repair of office furniture. Remember the furniture, the one that if we buy furniture or we repair anything connected with furniture is not deductible unless it is for a hotel. But the other thing they are saying under this category that the repair was done, even apart from that, the repair, note 6, of furniture was carried out by a local carpenter, not registered for VAT. So because even he was not registered, it means we are not charged VAT. Yeah, we are not charged VAT. But furniture, whether we are buying furniture or we are doing what with furniture, it's non-deductible unless that furniture directly is for hotel. It is for use in a hotel. But furniture that are not used for hotel, the input tax that we pay, it will not be allowed to be deducted. It will not be allowed to be deducted. So for this one, we are not including again because the repairs, we were not charged VAT. And even if we were charged VAT, we are saying we shall not include it because it is not for a hotel. It's not for hotel. So only allowed for the hotel because under the hotel, it is directly used for generation of VAT, whereby we are having the food, which is inclusive of VAT and so on. So for the audit fee, we multiply by this one. Then the salaries are not vatable, so we don't have salaries. Salaries, they are not inclusive, or we don't charge VAT on salaries, but salaries are charged payee. Payee is on salaries, but not VAT. So don't include that under the VAT because they are not vatable. They are not vatable. So we have the stationery, purchase of stationery here. Our stationery by the VAT. Then electricity bill for the month and it was not paid. Remember, there is something we call the tax point. The tax point is the earlier of whatever precedes the other, the earlier of whether we have received the invoice, whether we have paid full or part. That time you're supposed to be charged VAT. So the moment we received the moment we received the bill, it means VAT has already been charged. So regardless of whether we have paid or not, we are supposed to account for that particular VAT. Account for that VAT under the time of supply. Under the time of supply. Then the legal, having the legal fee. So legal fee by this, that way. Then purchase from traders not registered. So for purchases, you have to buy from registered for you to claim the VAT. So if you're buying from the people that are not registered, so there is no way they will charge you VAT, and therefore you cannot be able to claim that amount. You cannot claim because there is nothing to claim. Yeah, they were not registered. But for sales, remember we sell to both registered and unregistered. Yeah, both registered and registered. But for purchases under tax planning, you have to buy from the people that are registered in order to claim the VAT. So zero rated sales shall include them, but at 0%, 0%, at 0%, at 0% to get a 0 or a dash. Then we work with the additional, the one that we have not captured. Starting with note number 3, number 2 to be precise. Sales at standard rate includes goods valued at 278 sold to a credit customer who was declared bankrupt during the month. So if he was declared bankrupt, we shall claim the bad debt relief. We shall claim the bad debt relief. So remember, it was included in this. There are two ways. You can put it on the credit and you put the bracket. You put it on the credit, you put it in bracket, or you put it in the debit as a positive. Yeah, as a positive. Okay, the earlier of what data? Yeah, so the earlier of whatever precedes. When you talk about the earlier of, it's not the earlier of the data, because like in this case, assuming you receive the bill today, so that bill will be inclusive of the VAT. Whether we have made the payment or we have not made the payment, VAT must be paid. VAT must be accounted. Like, take an example, when you sell on credit, when you sell on credit, you will charge those customers VAT, regardless of whether they will pay next month. So when you are calculating the VAT for this month, you will include both sales, the cash and the credit. The same for bills. The bills that are paid later and VAT, you receive the invoice in advance before payment is made. Those invoices are supposed to be captured. They are supposed to be captured in, and therefore we shall account for that bill in this particular month, regardless of whether we have paid or we are yet to make the payment, because VAT doesn't operate on cash basis. Yeah, and that's why we are having the invoices. Remember, invoices are those for the credit. That's why we are saying it's the earlier of when the invoice is received or payment is made. And payment, not all, even part payment. Assuming we pay in advance and we have not received the goods, that time the VAT again is supposed to be accounted. That's why we are saying the tax point is that point that is earlier of those activities or events. When you receive the invoice, when you make the payment, if it is a project, when the architect certificate is received for the work that has been completed. Yeah, so not specifically the date, but the events that precedes or the event that comes first is the one that will be considered at the tax point. And the significance of the tax point, it determines the time that you're supposed to charge the VAT, time to charge VAT. So this side we have the bad debts. Yeah, bad debt relief, or we shall claim the bad debt. Under note number 2, the sales, where we had 278, 400 of a customer that was declared bankrupt. Remember, we had already charged that particular customer VAT. When he is declared bankrupt, he will not be able to pay, so we shall claim the bad debt relief, bad debt relief, bad debt relief, bad debt relief. Then note number 3, a customer returned goods sold at standard rate valued at 58 to the company, and a credit note was issued. Again, you have an option, but because we are using the T account here, return. Yeah, return inwards. Return inwards. So, or you can call it the credit note. Use that. Credit note issued. Yeah, credit note. Credit note issued. And remember, you have an option of putting it on the credit, but you deduct it so that it reduces the sales directly. It reduces the sales directly. But this side again, it will reduce the sales because we are debiting that value. Yeah, 580. Yeah, 580 was the credit note. No, it was 58, not 580. 580 is a different value. So 58,000, this one, customer returned goods sold at standard rate, valued at 58,000 to the company, and a credit note was issued immediately. So it was 58, which will amount to that 8,000. Then credit suppliers issued a debit note in respect of supplies at standard rate amounting to 580. When you talk about the debit note, they are used to correct an undercharge. Credit note is for overcharge, debit note is for undercharge, and they were issued by the credit suppliers here. So debit note received because we received from the supplier. So they normally correct the undercharge. So 580, and we multiply by our VAT rate, which now will be 80,000. Yeah, those are the debit notes that we received. And the last one, number 5, the accountant also established that an invoice of 480 from a foreign supplier was not recorded in the books. The import duty for these goods was at the rate of 20%. So these are imports. And imports, we say they are not inclusive of VAT. Yeah, that's why here they normally use the word where applicable. So in VAT inclusive is not applicable under the import. So we shall take 480. The first thing we include is the import duty. So here is where we shall multiply now by 120 to include the duty, and 16%. It's not inclusive. So 480 by 120% to include the duty, and we multiply by 16%. So the VAT is charged at the point of entry, on the port of entry. They are not sold inclusive of the VAT. And that's all. You just need to balance and see which side is bigger than the other. You'll find that in this case, the debit is more. When the debit is more, you have the refund. So VAT refundable. So VAT refundable in this case will be, yes.
I'm just wondering why both the credit note and the debit note are moving in the same direction. I expected maybe one to move.
Okay, so why they are in the same direction? We have said
Yes, I also have the same question I echo Silas. Because I tend to believe the return inwards is supposed to reduce the sales. So it is okay with debit. Then we get the VAT from the goods that have been returned.
Yeah.
But when you look at the next question, which is in respect to suppliers, it is a return outwards. So a return outward is supposed to reduce what? The purchases.
Okay.
So it's supposed to appear. My opinion is it's supposed to appear on the credit side.
Okay. On the credit side. So okay, thank you for that. But when you look at that note, in note number 4, they are saying that credit suppliers issued, so they have not talked about the credit note. They have talked about the debit note. It's not the credit note. So they issued debit note in respect to supplies at standard rate amounting to 580. So that's why there's a distinction between the credit note and the debit note. So credit note issued, we are issuing to the customers. If it was a credit note received, we shall receive from the supplier and we shall credit, because that one is for the return outward. But debit note that we received, the debit note normally corrects an undercharge, an undercharged invoice. That's why we are receiving the debit note. So if we received it from the supplier, means that what we had purchased at standard rate, it was understated. Yeah, and instead of issuing another invoice, they issued a debit note. So it's supposed to be debited, not credited, because it's a debit note, not a credit note. So debit note is for undercharge, credit note is for overcharge. And as you have explained to Silas, for the credit note, I have said there are two options. This one, it is correcting this. You can either put it on the credit, but you put it as a negative. Yeah, but instead of having a negative and you're dealing with the T, the moment you debit, automatically it will reduce the value of VAT that we had charged, or the VAT that we did not receive. And if it was a credit note that we received, we shall put it on the credit or debit, and we put negative. We put a negative sign. Okay, so explain why you use 120% on imports and not 20%. So for the importer, the 20% they are saying that we established that for 80 from a foreign supplier was not recorded in the books. The import duty for these goods was at the rate of 20%. So when you look at VAT on import, we normally say VAT on imports equals to 16%. It's normally 16%. 16% of CIF plus custom duty. CIF plus custom duty. So CIF is a cost, insurance and freight charges, and you add the custom duty. So the 20% was the customer. So already the custom is added to the value that we have. So for 80 is taken to be the CIF, the cost, and the freight charges that we had. If it was only the cost and we have the insurance and freight, we shall add them again, the insurance and freight, and we add the custom duty. So the 20% that you're saying is this. So yeah, if you take 20%, you shall again add it to this. So to add it completely, that's why this one is 100. You're multiplying by 120 to be inclusive, the cost plus the custom duty. That's why I've multiplied by 120. But when you do it, unless you do it as a working 20% separately, then you add to the initial cost and you multiply by 16%. Okay. So the VAT, so the input is more than the output. The input is more than the output, so we shall take this and we minus 855,172, the value, this one, to get an VAT refundable of 148,698, 148,698, and that is it for that VAT. That is it for the VAT there, for the VAT. Unless there is a question on the same, there is a question, that's where we shall stop at. We shall stop at that particular point. And so continue.
Maybe before
yes.
I turn off kidogo mwalimu.
Yes.
You explain the import kidogo.
Yeah, for the import, I'm saying that for the import, VAT on import is normally 16% of CIF value. CIF value is the cost, the insurance and freight, and you add the custom duty. Most of the time, the value that will be given, it will be the CIF value, the cost, insurance and freight. The only thing that will add is the customer. The only thing that will add is the custom duty. But if you are told is only the cost, they tell you the insurance was this and the freight charges was this. You're supposed to combine all the cost, insurance, freight, and again you multiply by, you add the custom duty. So custom duty is normally a percentage of this CIF value. Is a percentage of the CIF value, so that you get now the total cost of those items, which will be subjected to VAT at the rate of 16%. Okay, that's all. That's all for today, and thank you. Yeah, it was a nice discussion, and I know now by now you are able, to work it out, be able to see your speed, evaluate your speed, because now you're just remaining with 2 days. Yeah, by tomorrow is a week or even less than a week, because next week Friday is when you'll be sitting for your exam. So I wish you a good night.